Hello again, we continue our series dedicated to Elliott waves and how to interpret the Elliott waves on a financial product, be it a currency pair or a commodity, a stock index or a stock price, a specific stock price. It doesn't matter, the principle is the same. And in the first three parts we explain what makes an Elliott wave cycle, an impulsive and a corrective wave. Then we looked at the very basics of an impulsive wave and the very basics of a corrective wave, because it is enough for binary trading. Only these small things are enough for binary trading, and we'll use this part and another part only to illustrate examples on the current price action where the market is. So let's look at, this is the Australian dollar, US dollar. Any analysis should start from the currency pair or the product that you trade and the time frame that you use for that. So this is a daily chart. Being a daily chart, it wouldn't be smart to trade 60-second binary options, right? Or 1 hour or 4 hours. But we look for end of the week expiration date, end of the month expiration. I mean, if a broker is willing to pay me 80% rate of return, I can wait 2 weeks or 3 weeks or less than half a month for the outcome. Now, let's interpret this market starting with this move low from here. Let's look at it from here to here like this, to see if we can put the rules of the Elliott waves into this structure. So what do we have? We have here what? We have this move. Let's start with this move higher here. With this move higher here. Now this move high, if we look at it, we have a bit of 5 segments. Let's say we have what? We have 1, 2, 3, 4, 5. Correct? Excellent. Before jumping to any conclusion, check if you have an extended wave. Namely, at least one of the first wave, the third wave, or the fifth wave should be bigger than 161.8 when compared with the other ones. If you don't have an extension, that's not an impulsive wave. So let's go and take a Fibonacci. We said we take a Fibonacci expansion this time. An expansion. We go and click at the start of the move, at the end of the first wave, at the end of the second wave. Look where the 161.8 comes here. But we needed the 161.8 to come here. Therefore, this is now an impulsive wave because we do not have an extension. The third wave should have been longer all the way to here, then a fourth, then a fifth. If this is not an impulsive wave, things become quite easy, because according to the Elliot Waves Theory, there is only one other possibility that we have. We don't even have to count it. A move is either an impulsive or corrective wave. We just proved it is not impulsive. If it's not impulsive, it must be corrective, right? If it's corrective and it starts from the lows, then we can label it with wave A. If you don't follow me until now, just go and review the previous 3 video analysis. So wave A. But we said that in a wave A, here, what matters is its structure. We just proved that this is not an impulsive wave, but a corrective wave. We said that in a corrective wave of a bigger degree, if this is not an impulsive wave, the B wave must retrace more than 61.8. If this would have been an impulsive wave, the B wave should not retrace more than 61.8. Therefore, we just proved that this is not an impulsive wave. Hence, we go and take another Fibonacci, this time a retracement. We want to measure the move from here to here, and then price is mandatory to come into the 61.8 territory. Why? Because this is a 3-way structure, not a 5-way structure. So all this time here, maybe it won't be visible. Let's zoom in. maybe it won't be visible right, let's say right at the top, okay? But by the time that the move follows and the market comes around here, remember this is a daily time frame and so on, and let's assume you pick the move or you see the analysis only when you are here. It's still good enough for trading put options. Why? The market must go 61.8. Even here, it's good enough to trade put options. Now imagine, each candle here represents 1 day. So if you trade here, we trade with, let's assume it is, I don't know, it is a Wednesday or something. So end of the week, still good. Or end of the month, or 2 weeks, or whatever, according to the time frame. But let's zoom out this time, like this, and continue the analysis. So we have a 61.8, but we said that the B wave here, a B wave in a corrective wave, is a three-way structure all the time. So of a lower degree, like we have here, this degree in black, which is of a lower degree than the one in blue, then here, in order for this to be a B wave, and it needs to be a three-way structure, so it will be A, B, C, correct? That would be our B wave. Now the same principle that we use here, we can use on this move lower. We go and zoom in, and we look at this move here lower. Is this a five-way structure or an impulsive wave or not? Because if this is not an impulsive wave, then the market must retrace 61.8 for the same principle, an Elliott wave cycle, but of a lower degree this time. So we see that it's no way for this one to be a five-way structure because there's no extension. It's a corrective wave. We wait for the market to bounce, and then anywhere in this area, we actually turn around and we try to buy call options until market reaches 61.8, and then we let it go. And then if we have a move, if we have an A and we have a B, we start to look for the C wave. So we have A and the B. We know at this moment of time, because this is a wave A, it's a corrective wave, we know that the C wave must be impulsive. In a flat, you will have three-way structure, five-way structure. So whatever followed here must be a five-way structure, namely 1, 2, 3, 4, 5. Now it may or may not be, let's say, at this very moment, but in here, assume that we were here. If we expect this being a first wave, and we use the same rules that we said here, that the second wave cannot go beyond the start of the move, then what should we do when the market retraces like this? We go and trade call options, expecting for price not to come beyond the start of the move. 1, 2, 3, 4, 5. And just like that, we have an A and a B and a possible C. A few rules respected and understood properly end up in profitable binary trading. One more video analysis using a different example. We'll just go on the left side, pick a currency pair and see what the market will do. Bye bye.